Welcome, aspiring founders. I am absolutely thrilled to have you here for this explainer. Listen, you've got the vision, you've got the drive, and you are clearly ready to build. But today we need to sit down and talk about the actual fuel for that fire, capital. I'm going to be stepping in as your seasoned finance mentor today, and we are going to walk through the absolute foundations of business financing.
So here is the harsh reality we have to face right out of the gate. You might have a truly brilliant product idea. I mean, you've done the deep market research, you know for a fact customers are practically begging for this solution. You have the passion, you've got the perfect execution plan, and the raw determination to see it all through. But there's this one glaring problem staring right back at you. You simply do not have enough money to actually start or grow the business. So how do you survive?
Well, it's a brutal truth of entrepreneurship, honestly. Without funding, even the absolute best, most world-changing idea is just going to die on the vine before it even begins. You cannot run a high-growth tech startup without paying brilliant software developers. Actually, it's the exact same for Main Street, right? A small retail shop has to buy inventory, a restaurant needs to buy commercial ovens. Passion is essential. It really is, but passion alone doesn't make payroll.
But hey, before we start climbing that ladder of scale, let's ground ourselves. Because business financing isn't just about frantically grabbing cash wherever you can find it. No, it's the strategic art and science of obtaining the exact capital required to turn your blueprints into a living, breathing, profitable company. It's really about matching the right type of money to the exact stage your business is currently in.
So here is our syllabus for today's masterclass. We are going to cover bootstrapping and inner circles, borrowing from the bank, partnering with investors, modern alternatives, and we'll wrap it all up with the golden rule.
All right, let's dive into Section 1, bootstrapping and inner circles. This is the very first, most accessible tier of funding, starting small with the resources you and your closest confidants already have.
When you self-fund, what the startup world calls bootstrapping, you're literally using your own personal savings to cover those critical initial startup costs. And right away, you face the ultimate entrepreneurial trade-off. On one hand, the absolute biggest advantage is keeping 100% ownership. You are the undisputed boss of your baby, with total creative and strategic control. But on the flip side, your personal finances are entirely at risk. If the business fails, your personal savings account goes right down the drain alongside it. It's a really heavy burden, but strategically, it's often that necessary first step to prove your concept actually works in the real world.
Now, if your own wallet is feeling a bit light, you might naturally look to your inner circle. Getting a loan or an investment from friends and family who inherently trust you is honestly way easier than convincing a skeptical bank. But quick mentor warning here. Borrowing from Uncle Bob might get you the cash faster, but if things go south, well, it is going to make Thanksgiving dinner incredibly awkward, and that is exactly why you absolutely must have clear, professional written agreements from day one. You have to protect those vital personal relationships.
Okay, so once you outgrow that inner circle, we step up to Section 2, borrowing from the bank, the traditional time-tested route of formally asking a financial institution for a loan. The absolute crucial point here is intense preparation. Look, when you sit down with a banker, they do not care about your passion. They care about this strict checklist. They're going to demand to see your business income, a pristine personal and business credit history, an ironclad business plan, proof of reliable cash flow, and actual physical assets they can use as collateral. Banks are not venture capitalists. They are definitely not looking to gamble on your vision. They want absolute, mathematically guaranteed confidence that you have the means to repay their loan, literally no matter what happens to the economy.
And this brings us to the core strategic dynamic of taking out a bank loan. Yes, if you're approved, you get that vital funding while keeping total ownership of your company. You don't give away a single slice of the pie. But the heavy burden of this path is the mandatory monthly repayments. You owe that payment plus interest every single month. It genuinely does not matter if you had a record-breaking month of sales or if you didn't make a single penny in profit because of some crazy supply chain issue. The bank always expects its cut exactly on time.
Now, if the idea of those guaranteed monthly payments during a brutally slow month keeps you up at night, let's look at Section 3, partnering with investors, giving up a piece of your company for outside capital.
Partnering with investors is really a complete flip from a traditional bank loan. There are zero mandatory monthly loan repayments draining your precious operating cash flow. You get the capital and you can just breathe a sigh of relief as you put that money directly into growth. But the cost here is very, very permanent. You are surrendering a slice of your ownership, your equity. You're bringing on co-owners, which means you are no longer the sole decision maker sitting at the executive table.
But listen, as your mentor, I really want you to see that giving up equity isn't just a loss. It's actually a massive strategic gain. Good investors bring incredible value that goes far beyond just the money they wire into your account. They often provide deep operational experience, invaluable business advice from their own past failures and successes, intimate industry knowledge, and powerful network connections. You aren't just getting a check here, you are gaining powerful partners to help you navigate the incredibly chaotic, high-growth stages of your business.
Let's move to the next level and see how this builds into the absolute big leagues, venture capital. This is not for opening a local corner store. To secure VC funding, you first have to objectively prove the potential for rapid, massive growth. We're often targeting a billion-dollar market size. Then, step 2, you have to survive their microscopic, rigorous analysis of your market opportunity, your unit economics, and your team's capability. Only then might you reach step 3, securing this high-risk, high-reward funding. It's incredibly difficult to obtain, but it is exactly what fueled the early hypergrowth stages of almost every famous tech giant we use today.
Of course, right, not every founder wants to or honestly even needs to pitch a venture capitalist on Sand Hill Road. So let's shift our focus to Section 4, Modern Alternatives. Today's founders have some incredible financing tools at their fingertips.
There is just an incredible list of modern funding options out there today. You've got crowdfunding platforms that validate your product while raising cash, nimble online lenders, revenue-based financing that actually scales with your sales, peer-to-peer lending networks, and invoice financing to unlock tied-up capital. The strategic beauty of these modern alternatives is that they can often provide much faster, highly flexible access to cash, completely bypassing the rigid bureaucratic hoops of a traditional bank.
But hold on just a second. Consider this my stern warning to you as your mentor. Always, always carefully review the fees, the interest rates, and the repayment terms. Fast alternative money often hides incredibly steep fees right there in the fine print. Don't let the sheer convenience of a super fast online approval and a slick user interface blind you to the actual long-term cost of that capital. Because a quick cash injection can very quickly become a suffocating debt trap if you aren't paying close attention.
Which brings us to Section 5, the Golden Rule. This is arguably the most crucial part of this entire explainer. Really let this rule sink in. Only take financing if it helps your business create more value than it costs. Smart financing acts as a powerful catalyst to accelerate your strategic growth. Poor financing decisions, on the other hand, well, they'll just choke your business with unmanageable debt and severe financial stress. Never ever take money just because a lender or an investor happens to be willing to offer to you. Every single dollar needs a designated profit-generating purpose.
This really requires the ultimate mindset shift. The goal of your startup is not simply to successfully fundraise. Hoarding cash from investors isn't the finish line, and it certainly doesn't mean you've made it. The true goal is to strategically and wisely deploy that capital to build a sustainable, successful, and profitable operation that actually stands the test of time. So, I leave you with this really weighty question to ponder today. Which path will turn your specific idea into a thriving company? Are you going to bootstrap with your own savings to maintain total control? Will you brave the strict checklists of the bank to keep your equity? Or will you pitch investors and trade a piece of the pie for powerful strategic partnerships? Because in business, the right financing at the exact right time, well, it's magic. Choose the smartest funding path for your unique vision and go build something incredible. Thank you so much for joining me for this explainer. Keep building, and I will see you next time.